guys. Thank you so much for joining me today. Welcome back to the Pi Podcast. I am your host, Irene. As usual, share, like, subscribe, invite a friend and a friend of a friend if you do enjoy the content that I'm putting out. Equally, if you do have any comments you would like to share, let me know where you are on this journey. And if there are any topics you'd like me to cover in future as well, please let me know and I'll be happy to include this for future episodes. So today's podcast is going to cover an asset class that I think is highly overlooked, and I think is one that we definitely tend to think about from one perspective and not from a wholesome perspective. And so I wanted to sort of just switch the lens here, maybe move from a consumer perspective and come into an investor's perspective. So the asset class that we are talking about is an asset-backed security. Now, many of you may be aware of an asset backed security and what it is, perhaps not familiar with the language. So, let me explain exactly what this type of asset class entails. The products that sit within an asset backed security tend to be products that are linked to loans. So, if you think about a mortgage product, for example, you take out a loan. If you think about car financing, if you think about your general debt and loans that you take from lending institutions or from banks, if you think about your student loans, and it's essentially a world of consumer credit. And equally, you might be considering from a business perspective, if you're an individual or a company who's leasing assets. And so there's a lease borrowing cost attached to that. And equally, perhaps you're leasing machinery, equipment, or aircraft, and so on and so forth. So, this asset class, as the name suggests, asset backed security, is actually an asset class that is linked to an underlying asset. And you might wonder, how does this relate to perhaps a loan or student debt? Because for a mortgage, for example, or car financing, it's very obvious that it's linked to a property or a car, or even with leasing equipment, it's linked to an actual product. But when it comes to student financing and credit card debt and loans, what's the product that sits under that? Actually, this is what we call an unsecured product. However, the lender is lending you this money on the basis that your future income or your current income is going to be a good indicator of your ability to pay back that debt. So they're heavily relying on your income and your resources for this. Now that we've covered what asset backed securities actually are, let's think about how they work. So, these products essentially, if you think about yourself as an individual, if you are to go to a bank to borrow money for whatever reason, they tend to look at your credit score. They want to understand how good you are at paying back your debt. Equally, if there's a product linked to it, they might want to send their valuers to look at the product itself. Perhaps if it's a property, they're going to look at the value of the underlying asset. So, where is this property located? What is the pricing of properties around that area? How have they performed historically? What is the demand? And so on and so forth. They really want to understand the quality of that asset. And even when you're purchasing a car, they ask you what's the make and the model of the car, what's the year of the car, is it brand new, is it secondhand? They want to know all these things because they then want to do an analysis on the market to really understand how is this market projecting to perform in future? Is it a market that will have a heavy demand on second-hand vehicles? Because if we finance this product, is the borrower going to keep it at the end of the agreement, or are they going to send it back to the dealership? And all these factors play a role into the quality of the asset. And the quality of the asset, when you say an asset-backed security, the quality of the asset is a factor that plays very heavily on the suitability or the credit rating or the quality of the product in itself. There's different parties that have an interest in this type of product. So let's look at the bank to begin with. The bank is essentially going to pull together a group of these products based on whatever it is the consumer demands. So whether it's mortgages, whether it's car financing, and they're going to group them into different categories based on the similarities around each particular product. So you might find that they have a pool of mortgages, whether it's commercial or residential. They have a pool of car financing, whether it's brand new cars or secondhand cars. They have a pool of student financing debt, of credit card loans, which are linked to the credit worthiness of the borrower. And so once they've been able to group these assets into different categories based on the similarities around them, including even the interest rate. Remember, at this point, they have lent the money to you as a consumer. Let's use mortgages as an example. They've lent the money to you for your mortgage. They now structure these products in a way that they can present it to a group of investors. Remember, banks rely on consumer deposits and investors to be able to provide and meet the market need for different products. So these products have been packaged, and now the bank presents them to what we call an SPV, which is a special purpose vehicle that is used to house that type of security. So to demonstrate this to you, we have the bank sitting there. We then have the consumer, which is you and I, sitting there. We have a special purpose vehicle there, and we have the investor sitting there. So the bank gives you the consumer money. The bank approaches the SPV to get some sort of financing and investors behind the product. The investor puts their funds into the SPV to make an investment, and the SPV secures the funds, takes it to the bank. The bank can now proceed with their activities, and you sitting here as the consumer of that product start paying back your interest month by month, and that interest is directed back to the investor. So it's kind of like a square. There's a few more complexities within that. However, that's essentially the basics that you need to understand from it. Remember, with investing, we always talk about risk appetite, and risk appetite comes into play on the investor's part, which is where I'm trying to get you guys to be investors, right? So think about the investors who are investing in this SPV vehicle. The bank has presented them with products which have a mix of different characteristics, different credit ratings, and now they need to make a decision in terms of what they want to invest in. So risk appetite is very important because as an investor, you want to understand if you want a high risk product, a medium risk product, or a low risk product. As we've discussed previously, or in many of our episodes, when it comes to risk, the higher the risk, the higher the reward, or the higher the return. If you think about the characteristics of these products in the asset backed securities that have been put into the SPV, the credit rating agency will then come into it again. They're going to assess these products individually, perhaps take a sample of them, look at the risks associated with them, and then assign a credit rating to them. So the credit rating on asset-backed securities tends to sit from AAA all the way down to equity. So it's AAA, double AA, triple B, B, and then your equity product. With equity being the highest risk product, therefore higher risk, higher returns, and the AAA products are lower risk and lower returns. So as an investor, when this product is presented to you, you then select a product that fits your risk appetite, whether it's a triple A or it's an equity product that you're looking for. And this then determines the amount of interest that you're going to get back on your investment. To give you a few insights in terms of how the credit agency is going to view this in order to rate it, they might look at the geographical location of some of these products. Now, remember that we're living in economies that are very heavily reliant on credit and consumer credit for that matter. And so, if you know anybody who's ever taken out a loan, how many people are taking car financing, how many people are discussing their mortgages, we know that it's a market that has a very high appetite attached to it. And so, is it going to be a product that's investing perhaps in South America? Is it going to be investing in Europe? Is it going to be investing in Australia? And in terms of the way the bank has grouped these products, what's the concentration risk around and within that specific product? So, the individuals who are the borrowers in this case, are they all from the same type of industry? Are they all nurses? Are they all teachers? And what type of income do they have? Is it high income? Are they self-employed? Do they work in industries that are cyclical, like maybe actors? What are the risks involved there in their salaries? And there's many different aspects that are analyzed in order for the credit agency to assign those credit ratings. So once that's assigned, the investor then goes ahead and makes their decision based on their risk appetite and make an investment that is suitable for them. So now that we understand what this security is and how it works, I then want to highlight a few reasons why I like the asset backed security. As always, remember when you're looking at diversifying your portfolio, which is what we want to do, you want to ensure that you're seeking the right type of advice if you need it, to make sure that you're making the right investments based on your risk appetite or your investment needs as well, and whether this product is one that's suitable. I would say personally, I like this product because it's something that we can relate to, right? When it comes to credit, how many people are taking out credit? We are familiar with this product, we know what it is. Equally, when it comes to the income on these products, a significant amount of the income is actually returned to the investors. And that's how a lot of the products in this sort of asset class tend to be structured, that a lot of funds go back to the investor. This product is actually a bond security. It's a fixed income security. And so, for that reason, you can have it as a fixed rate or a floating rate product. And if you did have it as a floating rate product, it just means that when interest rates move up and down, then you benefit from those gains. And equally, on the other side of it, if interest rates go down, then again, the income that you're getting from that is not as high. However, if it is a fixed rate product as well, then you're assured of the income that you're going to get from your investment over time. So we've discussed the demand for the product. Asset-backed securities are going to be there for a very long time. I don't think it's an asset class that's necessarily going to disappear. It's one that's going to continue to meet consumer demand because consumer demand is so high. And for that reason, I personally like it as an investor. So another reason I like this type of investment is the fact that you get tax benefits from it. So think about investing in this through an ISA. You've got the obvious ISA tax benefit. Think about investing in a second property in the UK or being a buy-to-let investor or landlord. We know that the tax authorities in the UK have come down very hard on buy-to-let investors, and so the returns that you would get on your buy-to-let property are not as great as they used to be. And potentially looking at asset-backed securities might be something that gives you the return that you're seeking. Secondly, the stamp duty and land tax requirements for second homes in the UK is another factor that comes into play. So, because you're not investing in a property in itself, to be the sole owner, you're investing in a pooled investment vehicle. It just means that all those costs and expenses that you would incur as a second home or third home owner are absolutely wiped away, and you don't have to worry about that. Now that I've talked about the reasons why I like the security, let's talk about the risks associated with the security. So, the biggest one that we know, and I'm going to answer this because I feel that everybody is going to be thinking, why are you talking about asset backed security, mortgage products backed into security products? And we had the 2008 financial crisis where there was subprime mortgages that caused a catastrophe across the markets. I'm just going to use an analogy to simplify this for you. So think about the Walker's brand of crisps. We have several flavors across this. You've got your cheese and onion, you've got your salted, prawn and cocktail, salt and vinegar, barbecue, and the list goes on. Now, let's say, for example, the salt and vinegar flavor is not a favorite. Personally, it's not my favorite because I'm just not a fan of, I'm not a salt and vinegar girly. And for that reason, I'm going to say that in the 2008 financial crisis, we had an asset backed security that was one of the flavors of the different products within the space. And I'll call it a salt and vinegar sort of flavor. And it was a collateralized debt obligation that was linked to subprime mortgages. And so, because we don't like salt and vinegar, if I completely remove salt and vinegar from the brand of Walker's Crisp because I think it's absolutely atrocious, it doesn't mean that the rest of the brand is a terrible brand. Actually, you've got other products and other flavors within that brand that are well suited to the wider consumer market and are very favorable to the market. And that's the same thing that happened in the 2008 financial crisis. Collateral debt obligations were a bad investment, I suppose, because they were linked to subprime mortgages. And where we've talked about the credit rating and how the credit rating is, comes about, and how the rating agencies assign ratings to these products and how the banks pull these products together, we can see that being a subprime mortgage is a product that is sort of at the bottom of the food chain, and it did not work out very well. And so, for that reason, I would say don't be put off by the 2008 financial crisis, because it's just one flavor in the wider asset class. And the good thing about this is the fact that once there's been such an event happening in the industry, the regulators are very strong about it. They come in very strong, and they ensure that everybody playing in that space has the controls in place, are applying the regulatory requirements to the letter to ensure that that doesn't happen again. And so, in a sense, it becomes a security that is facing a lot of scrutiny, like significant amount of scrutiny, because of the challenges it's had in the past, which makes it an investment that is actually worth the investor's pound. So, the next thing after the 2008 financial crisis, let's think about COVID. And these are some of the economic conditions that affect this class of assets. So, during COVID, and let's focus specifically on real estate, let's focus on mortgages, and let's focus on income. Offices were not being occupied because everybody was working from home. And again, after COVID, we've seen that some companies have opted to permanently work from home, but on average, many of them are having their employees return to office on a hybrid basis. And so the use of the offices has increased. If we think about the offices being abandoned, then if we think about warehouse operations not really being as strong as they were before, because in terms of the goods they were storing, exports, like the market had ceased, and so activity was much less. People were not actually moving about in a way that was conducive to the economy. If we think about income, a lot of people in the UK were on what we call furlough, which means you are being paid potentially a percentage of your income, or you were not working full time. Some businesses struggled, and so people's income was fluctuating. These are some of the issues that would cause challenges to you as an investor when it comes to this type of security. So, if the borrower's income is affected, it means it's going to affect their ability to pay back that debt. And so that means the credit rating that would have been checked by the bank on their credit scores would have been really important to determine if this individual can actually pay back the loan in time and consistently and religiously. However, during that period of economic crisis, there would have been concessions given to businesses, to individuals, and from lenders to ensure that, because of the difficult economic climate, that individuals were being given grace periods. And so, for you as an investor, it may perhaps mean that your income may not have been flowing as consistently. However, every time we talk about investing, we talk about a long-term game. And so if you're somebody who's been in that industry, in that sort of investment asset class, then you want to be an investor who's riding out the waves. So when the market is challenged, then you want to hold tight. And when the market recovers, you also want to be there to make a gain and to benefit from that overall positive movement as well. And so we've seen that after COVID, in terms of the use of property, the general use of office spaces, now people are returning back to work and resuming, to report to the office full time. These asset class is sort of getting back its income, similar to what it did before. However, what we've seen as well is that alternative uses are being found for these spaces, because not every office is being utilized in the way that it was before, and there's been so many changes around that. So the dynamics of the industry as well tend to shift. However, it's a resilient industry in that property is an industry that is always going to be required. And asset-backed securities as well are going to be required, because people's income has returned back to normal. The need for borrowing continues to exist. And so, as much as these are challenges in the industry, again, just to stress, ride out the wave, be a long term investor, and you should definitely be in a position where you're benefiting more than should you be an investor who's looking to gain a quick bag, get in, get out. It might be that you're getting out at the wrong time during COVID, and therefore your portfolio is going to be in a negative position. So, finally, what do we need to have in mind if we're looking to invest in this asset class? Some of the things you want to look at, and I would say the main thing that you do want to look at is the asset manager who's investing in this portfolio. Because if you think about pulling investments or creating a security product from so many different consumers in the market and building a product from it, and then analyzing the risks around it and structuring it in a way that's suitable for investors and all the different complexities that lay within that type of structure, you want to ensure that the manager that you're investing with has a very good track record in the asset backed security asset class. Look at how they've performed over the last 20 years. Look at how they've performed during periods of challenge. So perhaps during the 2008 financial crisis, perhaps during COVID, and see how they've been able to manage the investor returns during that period. That's actually a key component that's going to help you decide whether or not to invest with a one manager over the other. The other thing is the fact that because they're doing so much work to analyze and provide a product or a pool of products that's a suitable investment, there's going to be a premium attached to this product. And that's a very good thing for you because as much as there's a cost underlying, it just means that you're paying for the skill and the expertise, which means it's a way of trying to mitigate your risk. It's not 100% mitigating your risk, but it should essentially give you that comfort that these managers know exactly what they're doing. And so you're in good hands. I hope that gives you sufficient information to take away and help you with your investment journey when you're thinking about asset backed securities or different ways that you can diversify your investment portfolio. So let's walk away from this with a mindset of not just being a consumer of consumer debt, essentially, and walk away from this with the mindset of being an investor in consumer debt. Because, as I've said, the appetite for this type of debt is significant, and you want to benefit both from a consumer and an investor perspective. So, thank you so much for joining me today, and I will see you next time. Bye for now.